Hi, this is Mason Case, and for my backtesting and investment strategy project, I decided to look and see if there was a relationship between debt-equity ratios and the change and growth of the stock price over the past 5 years. To look at this relationship is because I wanted to see if companies that were more willing to take on a certain debt ratio would have a greater increase in their growth and have more potential to grow than companies that had less debt. My hypothesis for the debt-equity ratio's effect on the stock price growth in 5 years is that the debt-equity ratio between 0.2 and 0.5 will be able to sustain a larger growth than other debt-equity ratios. The null hypothesis for this relationship would be that there is no effect between debt-equity and stock price growth over 5 years. Listed on the screen right now is all the data that I've pulled for the sake of this project. As you can see, I've chosen 50 stocks from the Russell 2000 index, and I've labeled them out and put their industry symbol. And then I also found the average debt-equity ratio of each of these companies over the past 5 years and calculated that. And then I found the stock price 5 years ago from now, and I found the stock price today, which is known as the ending price, and 5 years ago is the beginning price. And then I calculated the change in price between these two numbers, and I'm going to see now if we run a graph if there's any relationship between debt equity and the change in stock price over 5 years. On this chart, I have mapped out the data points on the debt equity ratio on the x-axis, and then on the y-axis is the change in price over the past 5 years in percent. As you can see, the majority of stock has a debt-equity ratio between 0 and 50. And down there you can see it's very hard to see if there's a trend in the relationship just from this graph, although there are some outliers that will skew the data. Right here, I laid out a regression analysis of the information I've gathered. As you can see, first for the R, it has a 0.0496, which shows that there is almost certainly that there's nearly no correlation between the two values. You can also see down at the bottom the average debt equity and coefficients. It assumes that if anything there may be a negative correlation between debt equity ratio and the change in stock price over 5 years. And another important number I'd like to point out is under the p-value. It has a 73.23% certainty that there's no effect between the average debt equity ratio and the change in stock price over 5 years. After doing the regression analysis, I decided to make a chart of information so I could look at the spread of information on the effect of average debt equity ratio on the 5-year change in stock price. So in this I found the median, the max, the range, and the median. What's wrong with that? According to this information I've gathered, I decided that I cannot reject the null hypothesis. There is no shown and proven relationship between the debt equity ratio and stock price growth over 5 years. Companies that were analyzed grew similarly, whether they were funded by either debt or equity. In conclusion, this data assumes that there's no relationship between debt-equity ratio and the change in stock price over 5 years. You cannot reject the null hypothesis. However, there may have been a problem with the test. If I would do this test again, I would probably make it so that I would add some more stock prices. What I would do is I would get different stock prices from different indexes other than the Russell 2000 to try to increase the variety.